Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lemus. Today's conversation is with Bruce Lipian of StoneCreek Capital. Max, what was the takeaway you had from our conversation with Bruce?
Bruce is one of the OG sponsors, maybe one of the most OG sponsors that we've had on the podcast. So it's always awesome to hear from guys that have been in the space for so long about sort of where it came from and where it's heading. And so there's a lot of nuggets there in this conversation. But also, I particularly liked when Bruce talked about convincing a seller in a proprietary deal, convincing that seller basically not to run a process. And this is something that's going to come up for lots of sponsors who are looking for proprietary deals. And as we've talked about, it's these proprietary deals that often offer sort of the X factor or the sizzle in independent sponsor deals because they're proprietary. There's no process being run. Sometimes the valuations are better. They're just often set up really well for a good return for the investors. So, just thinking through that a little bit, some of the reasons why a seller might not want to run a process that you can tap into when you're talking to them. I mean, when you're talking to strategics, for example, and obviously the strategics are usually going to give you the highest dollar value in these transactions, but strategics are competitors. There might be a fear of sharing customer information, pricing information, employee information. In those situations, if the deal breaks, which they often do, you've just shared a bunch of proprietary information with one of your competitors and oftentimes a much larger competitor. So that's something I think that can be tapped into. Another big theme that comes up again and again with, why a seller may not want to run a process or engage in a strategic sale is that the business may want to remain independent after the transaction, and the seller may be looking for their business to become a platform in and of itself, as opposed to just being another piece within a roll-up. So that's something where you have, culture and the brand of the business, and you're kind of tying back into the emotional aspects of the seller having formed the business and built that brand. So that's something that can be tapped into. And I think also, in some cases, there's fear that customers may react negatively. All of a sudden, you're selling out to sort of the 800-pound gorilla in the industry versus, the cleaner theme sometimes of, no, we just went out and raised capital and we've got these, strategic sponsor partners that are going to keep things mostly the same, but we're going to grow and we're going to bring in more money and we're going to, offer new services, and we're going to add more value for our customers. So there's a story that could go along with the sponsor route versus the strategic route. So, there's all these positives of aligning with a strategic partner, the biggest being you're probably going to get the most money, but there are some real negatives that go along with that as well. And I think sponsors are often going to have to highlight that and find other reasons to convince sellers to go the non-strategic route, the sort of proprietary route without running a process.
That's great. I'll call out just a pattern that we now see from this kind of group of OG sponsors. So Bruce is one of them. We've had Doug Song on the podcast. We've had David Acharya. David and Bruce and Doug all know each other, and they all make a point to educate the up-and-coming generation of independent sponsors. And they all, at least Doug does, I don't recall if David does as well, but they all also recommend to first-time, maybe even second-time sponsors that they not only seek mentorship from established independent sponsors, but actually partner with them on their first or second deal. So the benefits there are pretty obvious: the mentorship, the credibility that it brings, the need that we've also always heard, the need to have your first deal go well. This helps ensure that if you're arm in arm with an experienced sponsor. So the the point is that trade some of the economics. Don't optimize for economics for your first deal. Instead, ensure that it's a success. And one of the ways you can do that is by partnering with an established sponsor. So this is something that we've now heard a number of times, including from Bruce today. Nicholas, any takeaways from the Bruce conversation?
He mentioned an executive order from the White House in August of 2025. So this is less than a year ago, but it actually has very big implications in the private equity industry. And so the implication or the executive order is around retirement programs. And specifically now with self-directed IRAs, you are permitted to not only invest them in liquid assets and stock markets through a custodian, but also explore investments into alternative asset classes, including private equity. And this is kind of the motherland for private equity to get access to the country's IRAs and 401ks, but it has implications also in the lower middle market. And we know this because since August, we've been fundraising. We recently closed out Fund 2, Flagship 2 for Minds Capital, and 11% of our investors in that fund are investing through a self-directed IRA. And they did that without us even advertising it. We would mention it's possible during the fundraise, but this is something people are only becoming aware of. And it's a good match, right? Because private equity is a long-term illiquid investment. And retirement funds are long-term and illiquid if you want to preserve the tax benefits. And so they go a little bit hand in hand, actually. And especially for us who are still sub 40, it's nice to tap into that pool of liquidity because you won't otherwise access it for another nearly 3 decades. And we use that in Minds Capital. We will continue to do so in future funds, but independent sponsors can also tap into the same. And not only for their LPs, but also for themselves. And I think this can be important because a lot of independent sponsors who are 32 or 35 or 38 might be doing their first deal. They might not have that much liquidity. Their wife and their house and lifestyle has taken up most of their earnings. However, many of them have been in professional services and investing for many years, have built up pretty decent sized retirement accounts. And so when your LPs are asking you, hey, what's the skin in the game here? It might be hard to pull away 200K or 500K from your liquid funds, depending on where you're at. But you could potentially tap into your retirement account and say, yep, I'm investing 200K through that. So that's definitely something for everyone to be aware of, both in their fundraising, but also as they're putting money on the line themselves.
Great call out. Well, before we get to the interview, a reminder that at Minds Capital, we invest equity into independent sponsor-led acquisitions. Our check size ranges from 1 to 3 million, and we average about a commitment per month. So if you are a sponsor raising for a platform acquisition, submit your deal to us at our website, mindscapital.co. And if you're interested in investing in Minds Capital as an LP, there's also a pre-registration form on our website for accredited investors. So you can fill out that form to be kept in the loop on future raises. Again, it's mindscapital.co. Okay, here is the Minds Capital podcast interview with Bruce Lipian of StoneCreek Capital. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Bruce Lipian is based in Newport Beach. He is a co-founding partner of StoneCreek Capital. Bruce and his partner, Drew Adams, have sponsored or participated in over 50 acquisitions, totaling over $2 billion in value. Since 2010 alone, StoneCreek has acquired 21 businesses. In 2024, StoneCreek won the iGlobal Independent Sponsor Lifetime Achievement Award. Bruce mentors independent sponsors and frequently speaks on panels at the conferences. Bruce Lipian, we are thrilled to have you on our panel, virtual panel here today. Welcome to the Minds Capital Podcast.
Thank you.
The Lifetime Achievement Award, Bruce, to hopefully not make you too uncomfortable, but why do you think you won it? give us kind of a picture of your years of experience in this community?
Well, the only uncomfortable part asking me that question is, I just hope I haven't peaked at this point. But myself, and there are several other long-suffering independent sponsors who I would say are considered influential in pioneering the independent sponsor model we've got today. And when we started to pursue this model, which was after we'd had committed capital and it was fully invested, Drew and I decided to start doing deals on a standalone basis. And we didn't know that there was a name for this, and you didn't see very much of this. It's very common in real estate to raise capital on a deal-by-deal basis, but in private equity, pretty uncommon. And we got this email saying that there was a Fundless sponsor conference in New York. This takes us back to like 2005, 2006. And we were delighted to see that there was actually something that was dedicated to helping people do deals this way. But I almost threw up when I saw it was called a Fundless sponsor conference. Like, are you kidding me? That's the label they give to people who don't have any money? Well, anyway, we didn't let that scare us away. We went to the conference, and it was great. Maybe 50 people. And there were a handful of us who had dinner afterwards, who were Fundless. We're just going to refer to it as the F word now instead of any other label. And at dinner, the more liquored up we got, the more pissed off we got that we had this name. And so we all started saying, we got to come up with something better. And somebody at the table said, well, what about independent? Hey, now that's not bad. And then somebody else at the table said, well, I know the organizer of that conference. I'm going to call him tomorrow, see if he's going to do this again. So he called the organizer, said, you could do it again. The organizer said, yeah. And then he said, look, could you change the name from Fundless to independent? Because it's killing us to have that label. And that guy said, yeah. And the next conference was an independent sponsor conference. Now back to the Lifetime Achievement Award. The six of us and others became active in being on the panels of those conferences, and both getting up there and saying, stop calling us Fundless. We want to be called independent. And in addition, really bringing legitimacy and credibility to this model that is easy for people to be dismissive of. How can it be relevant if you don't have committed capital? And I'm just proud to have been part of that. And it wasn't easy to get people to stand up and talk about it back then. Why? Well, who wants to publicly reveal they don't have any money? Okay. You get up there, then if somebody checks you out, they're going to find out you don't have a fund. So, and then of course, being able to do deals successfully with credible capital providers, have, continuity of investor support, from deal to deal. I think we helped enlighten, and also we were active. So I guessing that's why we got the recognition that we got.
Well, we've heard kind of versions of the story. Anybody who's been in this space for more than 15 minutes will have heard that it used to go by Fundless sponsor, now goes by independent sponsor. So it's fun to hear the front lines of the story. But
I got to interrupt you, because if any of the other five guys take credit, because we all take credit, okay, they deserve some of the credit too.
But it does sound like, other than the discomfort of announcing oneself as Fundless, that it could have really made a material difference in accelerating the adoption of the model, the change in brand. It's kind of interesting trivia that we all hear, but I wonder if it actually really made a difference in the market and how much it started growing.
What I think made the biggest difference in the market, because to me, this was more seismic, and yet, unless you've been on the journey, those of us who've been doing this for a while have been on, is at that time, it was embarrassing for a private equity group to invest in an independent sponsor deal, because how do you explain to your LPs when you make your capital call, hey, we're going to do a deal and StoneCreek brought it to us, and by the way, they're getting a promote, and they're getting an ongoing management fee, and they're getting a transaction fee. When the LP calls you up and says, well, why are we now paying a second promote? Why are we paying double management fees? When isn't that what we're investing in you guys to do? And why don't we just go to them directly? And it took a handful of groups with committed capital who saw the value of the independent sponsor to let their LPs know that this was a source of credible investment opportunity that they didn't want to overlook just because there was additional premium associated with that. And as that became more evident, LPs started going, I mean, today it's just night and day. Back then it's, why are you doing an independent sponsor deal? Today, LPs are saying, what's your strategy for building deal flow from independent sponsors? And once that, it was really, it was a paradigm shift in terms of the community recognizing that these are worthwhile opportunities to look at. And quite frankly, independent sponsor deals aren't getting done, I don't think, unless they're as good or better than what those groups with committed capital are looking at, because they've got to pay extra to do that deal. But if the independent sponsors come to the capital provider and said, look, this finger on the bow, we've got exclusivity, negotiated terms, reasonable multiple, backable management, compelling value creation strategy, the whole litany of things that would be check the box items. And it's inclusive of whatever dilutive impact we would have on their economics. Makes sense to do it. If it isn't, it doesn't make any sense to back the independent sponsor. So that's really, the independent sponsor community has really proven itself as a group of deal finders who were rolling up their sleeves, beating the bushes, and finding, compelling opportunities.
So independent sponsors have to come up with better deals than the PE fund counterparts in order to attract capital or those capital providers. But of course, independent sponsors have much less resources than the funds. So you're trying to find superior deals with less resources. Like, how do you do that? And how come someone in that position has been able to disrupt the entire lower middle market and soon middle market of the private equity world?
That is a great observation. And it's just as an aside, when I would get up in the early days, for that very reason, I would stand up and say, what we do is amazing. Think about how hard it is to get somebody to give you exclusivity when they know you don't have any money, and how hard it is to attract capital if your deal has, an additional cost that they don't have to handle. And what you see, I believe, is a group of very entrepreneurial, private equity oriented individuals who have gotten great experience being with a private equity fund, being with an investment banking firm, perhaps being an M&A attorney who does transactional deals. And also, it's important to compartmentalize the market. The independent sponsors at the micro end of the middle market. The typical independent sponsor deal, let's call it 10 to 50, and there's probably more of them that are between 15 and 30 million. That has not been a very crowded field because so many private equity funds, it's not going to move the needle enough to do those kinds of deals. So, and the smaller the company, typically the more hair it has on it, or the less professional management it's got because it's still run by the founder, or it's a family-owned business. There are a lot of things where we are getting the opportunity was there because the number of potential buyers just wasn't as great. And so that's one reason. Second, the category of financing source that really got this and didn't have that level, or really didn't have resistance, is the SBIC funds, who are in place to provide smaller, they're originally formed to provide 7-figure type financing to smaller companies who couldn't get it on their own. And the SBICs were traditionally just mezz lenders. But for those of you who understand how the SBIC fund works, 2/3 of their money is debt and 1/3 is equity that they raise. And so the original program was just focused on mezzanine debt financing, not control deals. And yet, since 1/3 of the money they had to deploy was in the form of preferred equity with an accrued dividend, there were a group of SBICs who recognized, well, wait a minute, why don't we put up all the junior capital? For the 2/3 that we're borrowing from the government, we'll keep that in the form of sub-debt, and then we'll be able to pay the coupon on the interest that we owe the government by getting interest payments. But on the 1/3 that we don't have to pay interest on, we can put that in the form of preferred equity. So in those deals, as long as you could find senior debt, you could plug the gap with SBIC funds, 70% sub-debt, 30% in equity. And now they're actually a control investor. They're not a mezz investor who's basically waiting for their monthly or their quarterly payments. And yet, because the DNA of the SBICs was mezz orientation, it became a natural fit to team up with experienced independent sponsors who could play the GP role on their behalf. And they wouldn't have to add additional people. So I may be giving you more detail than you need, but there are a lot of elements that came together that helped fuel this. And I'm going to say the last piece was a thing I talked about before. PE firms followed SBICs as they started to become more aware of these kinds of deals.
What role do you think independent sponsors play in the SBIC program universe these days?
Huge.
Independent sponsors to SBIC, not
no,
the other way around.
No, it's huge. And the reason I say it's huge is that the SBA, which is the lobbying organization for the SBICs, created what's called ISF, the Independent Sponsor Forum. And that is a dedicated program where they put on conferences, independent sponsor conferences, bringing capital providers together with independent sponsors. And even though that's not dedicated just to SBICs, it's one of the things that's so great about it is that it doesn't have that just restriction, but it benefits that community significantly because of how active they have been in putting their capital into independent sponsor deals. So I can't imagine, a better endorsement of what independent sponsors are doing than to see an organization like the SBIA make such a commitment to our community.
We read in headlines these days about how private credit has run into trouble as a broad category. It was very popular 4 or 5 years ago as a way to get a double-digit coupon, but too much capital, too much supply, chasing too few deals, right? That's how it goes. Do you think SBICs should be categorized with private credit and that the returns that they saw maybe in the 2010s are on the way down? Or do you think SBICs have remained very disciplined and especially in this ecosystem?
I think they've remained very disciplined. This approach, I think, is growing in acceptability. But the SBICs have a credit discipline associated with deploying their funds, but they also have figured out, and we've probably done more deals with SBIC financing than other sources of capital, how to work so compatibly with independent sponsors. And the reason for that is we fill a need that they've got so they can continue to do this. I also, it's a program that is really time tested in terms of results. So they may be migrating more into a hybrid, but I'd say by and large, SBICs have a mandate to put more money out in the form of debt than in equity. And it's uncommon to see an SBIC that'll just do straight equity without debt. And in that regard, I haven't heard much that's put a spotlight on that category. I think, in fact, I just spoke to one of the people in the SBIA organization, and they have upped their commitment to continuing to facilitate SBICs. One other thing I want to mention on the private equity side, in terms of what made things change, is that the private equity groups have a need to deploy their capital in a 5-year period. They don't have that as money in the bank. They get a commitment from their LPs, and it's like a 5-year letter of credit. They're obligated to send you money in 10 days after you make a capital call. As the competition for deals and the purchase price, competition has grown, purchase price multiples have grown, and the need to put in more equity than debt has grown. These groups have not been able to deploy their capital at the velocity that they need to put all that capital to work within that 5-year period. So a way to augment the typical deal sourcing to make sure you're not losing unused commitments is to also have a channel focused on independent sponsors who can both help you deploy that capital, but equally important, without you having to deploy additional resources because of the experience that the independent sponsor brings to the table to be an extension of your firm. So that's another piece that I think's come into play.
You say that purchase multiples have gone up, and that's become a challenge for PE funds. Has that also happened in the lower middle market, and is it equally challenging for independent sponsors now versus 5 or 10 years ago?
For sure. However, in the micro end of the middle market, because of the fact that there's more hair on these deals and there isn't as much, I'll say, competition for these deals, we're looking at deals that are appealing in the 4 to 6x multiple range. Now, there's a reason that they're lower multiples, but part of our job is looking under the hood or peeling away the layers and seeing if there's if it makes sense to invest in that particular opportunity. And several of our deals along the way, we've been able to connect with the management team and see an investment thesis and a track record that enables us to overcome initial pushback on deals. So much of our job in doing this successfully is anticipating what people are going to push back on. And if we feel confident that we can address those issues, especially getting a deal at a more reasonable multiple, that's the kind of deal we pursue.
You've been around in the space. Anecdotally, what is your perspective on the return profile, a standard down the fairway exit in this space, and what's the variance around that? And also, how has it evolved over the last decade or two?
I think originally we were all looking for returns on a base case deal in the low to mid 20%. And now it's more in the low 20%, high teen type percent. And just from a multiple return, I'd say investors are looking for a 2.5 to 3x MOIC at exit. And when I first started doing deals, we were looking at 40% rates of return, which equated into something closer to 5x. So there's a lot of factors that have brought that down. It's not just purchase price, but the amount of equity that's going into the deals versus the amount of debt. So we feel comfortable underwriting deals that on a base case, readily achievable is going to be a low 20% rate of return. But we also always put together an upside case that's reasonable but more aggressive. And it's important to make sure that your deal has some element of sizzle. It may be lower probability, but that the foundation is there to capitalize on. And to the extent you've got an investment that's got a really solid foundation, but a compelling value creation strategy, it's kind of the best of both worlds from a risk reward point of view.
Tell me more about this. Will and I often talk about ourselves as steak and sizzle. He's robust, and then I try to be sizzle with mixed luck. But sizzle, as it relates to underwriting a deal, tell me more about that. That really piqued my interest.
Well, I'll just give you an anecdote, which I was looking for an opening to share this, so I'm going to use this as my opening. But this deal to me is indicative of how an independent sponsor is the right party to do a deal with. So several years ago, we acquired a company called Cova International, and Cova is the leading manufacturer of disposable urinalysis testing supplies. When after an most urine tests are conducted through an automated machine, but it's not able to diagnose everything. And if it's unable to diagnose through that automated process, the sample goes to a lab where somebody puts it in a test tube, puts it on a slide, looks through a microscope. And that's what this company made. And they've hugely profitable, 50% EBITDA margin, 12 million in revenue, 6 million EBITDA. And yet it was a annuity. So if you want to talk about core stability, but no sizzle, this company fit in that category very nicely. And the private equity group by the name of Linden looked had acquired a company called Highcore Biomedical, and they had two divisions. One of them was Cova, one was another one. They didn't want Cova. They wanted the other one. So they actually hired an investment banking firm to sell Cova under the premise that they could use that cash to pay off the debt and have the other one debt free. So I hired an investment banking firm. They went to market and they were unable to come close to what the seller's minimum number was. So they pulled it off the market. And the guy who was created this was basically came up with the patents for these products and was running the company, wanted to buy it. And so he contacted, the Linda and said, "Hey, would you guys be open to my buying it?" And they had to laugh because a very well-known investment banking firm tried to sell it and weren't able to get a high enough price. And they said, "Sure, knock yourself out." Well, he got introduced to us. We teamed up with him. We were able to get the deal under LOI at a higher price than the highest price that they got. It was still below the bogey. But at that point, they were more focused on, look, let's just get that liquidity. Let's get this sold and let's move on. Long story short, we not only got a busted deal done, and one of the reasons I mention that is that independent sponsors are a very worthwhile group to approach if you got a busted deal, because we can go to a different network and without the vulnerability of going back to the same people you talked to before, but who now know that you couldn't get your deal done at the original price. We not only got that deal done, but we were the private equity groups that we brought to the table looked at this as a platform for growth, and they put in a certain amount of money at close for this, but they set aside 3 times that amount in dry powder for add-on acquisitions. As a result, we had an enormous amount of dry powder for add-on acquisitions in addition to getting this busted deal done. So if you look at us being an independent sponsor, we were an ideal partner for this individual who didn't have the credibility to go and do the deal himself. We got comfortable that we could get the deal done because now we knew what the market was willing to pay, and that we could get the deal done at the lower valuation. And we had a capital structure that gave us additional dry powder for add-on acquisitions. That's not a common independent sponsor story, but it came together because of our being an independent sponsor.
Because of those dynamics you said at the beginning, where you can bring in capital who wasn't exposed to the deal before it died.
The answer is yes. But on top of that, we can go to capital providers who perhaps looked at it before, but more often than not, we've got a better story to tell in this particular case, because this particular division was just viewed as an annuity. Nobody was listening to the CEO's suggestions for creating value. Look, don't mess with that because this is funding all of our other operations. Let's just keep the golden goose alive. So we were able to also talk about value creation opportunities that weren't getting any attention before. What helps StoneCreek be successful, and I think this is a very important thing for any independent sponsor to reflect upon, is how much opportunity there is to use the flexibility of the model to positively position yourself when you're competing against private equity. So earlier in the podcast, I mentioned we came in after a busted deal. as an independent sponsor because we had a different value proposition to bring to the table. And I could not have made the argument that I can keep your process alive without you having additional vulnerability in a compelling way if I wasn't an independent sponsor. Because I'm going to protect you on one hand, and I'm going to go to parties that weren't approached previously. I can only do that as an independent sponsor. Likewise, we're the ideal partner for either an emerging independent sponsor or a backable management team who has everything they need to get a deal done, but they haven't had the success of getting a deal done. As an emerging independent sponsor, we can team up, but we're not beholden to anybody. Now we're co-independent sponsors, and that creates opportunity for both of us. StoneCreek couldn't do that if it wasn't an independent sponsor. I'm going to close with one other example where the better you understand your independent sponsor mess, the more you will recognize opportunities. So this is just one of my favorite triumphs. I was at I was invited to an offsite event and happened to sit next to, and it was both the relationship with the sponsor as well as their spouse. So I'm sitting next to the spouse of the person who was invited. And I said, me being in the dark ages, what do you do to keep yourself busy? And she said, oh, I'm CFO of a company. And I'm thinking, okay, well, how big is a company? Well, we do about 90 million in revenues and 15 million EBITDA. And I'm like, just, you idiot, just not realizing that just because she wasn't the invitee didn't mean that she wasn't one hell of a operator. And she told me about the business. And one of the most interesting things was she said, when we get ready to sell, we're only going to go to financial buyers. I said, why is that? I said, well, our company was formed through a merger of two companies that were the last two in this industry segment. And that our partner who has 30%, we've got 70%, is a strategic player and does not want this company ending up in the hands of another strategic buyer. So we got to go to financial buyers. And that's when I had an epiphany, maybe one of 5 I've had in my lifetime when I needed them. And I said, oh, that's interesting. I said, so I presume you're going to hire an investment banker and do an auction when you get ready to sell? She goes, yeah, absolutely. I said, well, I'd like to suggest an alternative approach here. I said, ordinarily, that makes a ton of sense. So you can get the highest price through a traditional sell-side process. But if you're telling me that you're only going to go to financial buyers, your corridor of valuation is going to be very narrow, maybe 1x. And why is that? Because if none of the people who are looking at this have a synergy to bring to the equation, they're going to be limited by how much debt they can access, and they're going to be limited by how much equity they're willing to put in. So maybe it's 1 turn of EBITDA in both cases. I said, let me tell you what we do. And I explained the model. And I said, whenever you guys are ready, I'd love to meet you and the CEO. And these are the 2 people who owned it of the 70%. And because I think we could accomplish your objective with so many benefits that you wouldn't want to do an auction. And I said, first of all, since you were the CEO and CFO, I know we could get access to the information we need. So you wouldn't have to bring any of the other management team into the circle to get us the information. Second, if you agree that there's a narrow corridor of value, even if you have an auction, then it would be relatively easy, I think, to reach agreement on a value that you would want to sell at. Third, we can avoid all the invasiveness that comes from doing all these tours. And lastly, you don't have to pay a fee to the investment banker, and we can get it done way quicker. Now I'm thinking, okay, that's interesting. A month later, I get a call from her saying, look, I talked to the CEO. We'd like to have you come back to New York. And I'm like, holy crap. Somebody actually listened to me for a change. And we went back and we got that deal under LOI. My point being that it took an understanding of what differentiates us in a positive way to actually position ourselves and prevail. And this was a $90 million deal. That's not typical. The independent sponsors are going to get that on a proprietary basis. So hopefully that's enlightening in terms of recognizing how the combination, by the way, of flexibility, but now credibility is huge.
So let me revert that back to the discussion on stake versus sizzle, because I
Yeah,
think
well, I
a
was
lot
wondering
of
when we were going to get back to that.
important to get back to that. And I think a lot of sponsors, when they present us deals where they're looking for capital partners like Minds Capital, they come with good deals. They're robust, they're stable. There is a general absence of reasons to say no. That makes for a good deal with good downside protection. Yet sometimes they lack upside. And investors in this space are, as you said, they want 2.5, 3x or more in returns. And so you need to see that upside. You need to get excited about that upside. And I call it green flags or X factors. I think you call it Sizzle. Is that what you're alluding to?
Absolutely. If we don't have that element in the deal, we're not going to have the confidence we have that we're going to be able to attract the capital we need to get the deal done. That's a very important element. The other thing to recognize about the typical independent sponsors, StoneCreek is two guys. It's me and Drew. We can't afford to go down too many, dead ends because it's us. So we know what checks the boxes. And what you just mentioned is are very important boxes to check.
What are the biggest sizzle factors in your mind? Like what excites investors the most if you had to name 2 or 3?
Well, oftentimes, categorically, it's limitations. But now I'm going to be talking about existing leaders of a company. Okay, so we're not talking about finding somebody, teaming up with them, and then buying a company where they've got a ton of expertise. Right now, I'm talking about an MBO, management buyout.
Right.
In a lot of these situations, the management team are not the controlling shareholders of the company. And so this event, which typically is designed to put liquidity in the seller's pocket, is also an opportunity to have a new partner who's really excited about embracing what the management team wants to do in this next stage. And these types of deals don't make sense unless you can point to a strong enough historical track record of sustainable EBITDA, let's call it over a 3-year period or more, because that's how you attract the debt financing, which is tied to predictable cash flow, right? But, if it's a lifestyle business that the owner's basically clipping coupons, or perhaps new initiatives would require third-party capital that the owner does not want to take the risk of putting up his or her self, we love to ask the following 2 questions when we meet management. What have you had to do that you wish you didn't have to do anymore? Okay, so let's call those, and 2, what would you like to do that you haven't been able to do? And let's not talk about capital restrictions. We can go through an exercise and see whether the capital requirements are too large for that to make any sense. But oftentimes it's a combination of both. And then when we raise capital, it's awfully important to properly set the expectations with our capital partners as to what additional capital is going to be needed to capitalize on the upside opportunities. So again, it's something, and we're generalists. So I can't talk about a certain space and talk knowledgeably about kind of which way are the winds blowing and it's ripe for consolidation and this and that. StoneCreek is way more, it's had success teaming up with backable leaders that have these opportunities.
So an incumbent and continued management team, that's a Sizzle factor. What else would you point to?
Relatively low risk, but achieve a realizable opportunity to increase the cash flow relatively quickly after there's a change of control. The surest way to have a good investment is to lower the risk and have higher cash flow when you sold it than when you bought it. Okay, that's a really simple. And so one of the things that's so fundamental to us is not only getting comfortable with the opportunity that's ahead of us, but making sure that the numbers we're underwriting are imminently achievable. What I mean by that is oftentimes people say, what's the exit strategy? How are you going to get this value up? Well, if we've got a plan that's got steak and sizzle, I just want the team to beat the plan and hopefully really exceed it. Why? Because you got more options if you're a winner than you do if you're a loser. So if you have exceeded plan, established your credibility, not only is that going to increase value because that's what you underwrote, but the ownership group is more than likely to give that team more resources because they've proven their credibility. So that may be more of a holistic way to look at it, but that's a really important fundamental is achievability versus falling short.
And I have to imagine that's where a reasonable entry valuation comes into play too.
Absolutely. Why is that? Because we're always looking for a compelling story for exit multiple increase. So that, if we bought in at 6x, is there a compelling story that says if we can take a company from under 5 million EBITDA to north of 10 million in EBITDA, and the wind is still at its back, and the fundamentals there, and the same team is going to keep doing what they're doing, you're going to get a pickup in exit multiple just because the size is higher and the credibility is more established. So that arbitrage comes from accomplishing those objectives.
Bruce, you work with emerging, much younger or earlier in their career independent sponsors, as we said at the top. And one of the things that you tell this group of less experienced sponsors, one of the things that you advise is partnering with older sponsors, at least for that first deal. And you yourself have done some deals like that, as I recall. Why? Tell us more about that structure or that recommendation that you have, assuming that probably a lot of people listening to this are either aspiring or at least very early in their career independent sponsors.
I want to qualify this, and I start by trying to talk them out of even doing this at all before I start saying to how we can work together to do it successfully. Because there are, so many challenges that go along with that. And the reason that the teaming up of an experienced independent sponsor with an emerging independent sponsor, and that I define that as groups that either haven't done a deal or they've gotten one deal done, but especially for those who are still trying to get that first deal done. My favorite phrase to capsulize this is an opportunity to learn how to shave on somebody else's beard. You shouldn't go down the path of being an independent sponsor unless you have the credibility to get deals done. So you really need to have that experience of PE or lending or legal or whatever it is, but you really know how to get a deal done. And quite frankly, you shouldn't do this if you don't have the credibility that's going to make you appealing. And by the way, I should have said this at the beginning. I've been talking exclusively about institutional capital providers. The circumstances are different for family offices or high net worth individuals. So we could talk about that, but I just want to make a point that this is getting institutional capital, which is what StoneCreek has done over the years. A backable operator is going to have the credibility to get institutional capital backing if they've got all those fundamentals we talked about. And an experienced deal person, I believe, is going to be able to get capital. The challenge in either case, if you haven't gotten a deal done yet, is you're lacking the credibility to get exclusivity, which is way harder, regardless of how successfully you've positioned yourself. Because when the question comes up, how many of these deals have you gotten done? And you go, well, I'm hoping this will be my first. That's not a position of strength. So one of the benefits to an emerging independent sponsor is if you team up with an experienced independent sponsor earlier rather than later, then you can augment the credibility you've already got with the credibility in a experienced independent sponsor has in terms of giving the seller comfort about certainty of close, which is the ability to find the capital and demonstration of your ability to get deals done. And on top of that, that emerging independent sponsor now gets exposure to funding sources that the experienced independent sponsor has well-established relationships with. And the earlier that the emerging independent sponsor teams up with the experienced independent sponsor, the more valuable that's going to be. If we get a call from an emerging independent sponsor and they're calling us because they're desperate, because they've gone to every name they could and they just didn't get there and the clock is ticking on exclusivity, that's not something that's going to make sense for us because we don't get the opportunity to utilize the resources we've got who perhaps could have that be a different outcome. Second, we've got experience negotiating with capital providers. And so there's a learning curve associated with that. So we believe, and I think any experienced independent sponsor who's got this kind of experience, we're going to get better terms between us and the capital provider. And then you get the benefit of an awful lot of things we've learned the hard way, those of us who are still standing after all these years. And particularly when it comes to documentation, there's certain vulnerabilities that an independent sponsor has that are unique. And so being able to utilize those, I'm going to call it best practices, just stacks the deck in your favor to get that first deal done. And once it is done, you probably don't need that experienced independent sponsor by your side. Because the next time someone asks you the question, oh, I just closed the deal.
What are some of the vulnerabilities you just touched on?
Well, you've got to be sure that when you negotiate your economics, your documentation doesn't open up the door for your capital provider to negate whatever your agreement is. And that's where how the management services agreement is drafted and how the operating agreement is drafted. And those are the two documents that cover your economics, don't have language where they could say, we're going to terminate this agreement. And the reason that's really important to be sensitive to is because it's the only place where your interests aren't aligned with your capital provider. Because if they could terminate your agreement, then they get better economics. And there's nothing nefarious about this. It's just a reality that you need to protect yourself. So one of my pieces of advice to emerging independent sponsors is when you get to a stage where you're doing documentation, engage legal counsel that's experienced doing documentation for independent sponsors. They'll know how to protect you. But there are an awful lot of folks, who have been successful that are more likely to go to maybe a, higher profile law firm, pay higher legal rates because of how good those folks are. But because the independent sponsor is largely focused on the micro end of the middle market, many of those legal professionals don't really have a grasp of how to protect their clients that are independent sponsors.
Bruce, shifting gears for a last segment here. In the pre-call, you mentioned the peaking of the model and that we're likely to see, or that you think we might see something of a shakeout, mortality rates increase. I think you put it. Say more about that, please.
Well, having reflected on that part of the pre-call, I'm going to qualify that a little bit. One, because of an external factor that I'll go into in a minute. But second, I don't think the demand for independent sponsors is going to decline because of all the factors that have led to the independent sponsor being an integral part of the lower end middle market ecosystem. I really feel like we're here to stay. And that type of partnership has proven itself. Where I say we're going to see a fallout, it's more along the lines of a lot of people who are doing this today aren't going to be doing it 18 months from now. And the more crowded it gets with emerging independent sponsors, the less you're going to see of the same people year after year at the conferences. There's so many challenges, regardless of what your prior experience is, to understand how to be successful convincing a seller of your credibility to raise capital. And even if you do, this seller's advisors are going to try and talk the seller out of that. They're going to go, where's that group going to get the money? Well, they're going to find it. Okay. You need to have experience, understand. This is different than having a capital call at a PE group and 10 days later, they send you the money, no questions asked. Okay, so that's securing something. On the private equity side of the equation, it's very important to know whether that group you're talking to has done an independent sponsor deal before, because they've got a learning curve of their own. And that's because they're control-oriented investors. They haven't had to worry about being accountable to another party when it comes to underwriting an investment decision or managing that investment after the deal closes. And so there's just an awful lot of, because of the situation, the dynamics are different and they're tricky folks who should be independent sponsors are going to figure that out. But it could take 2 years, 3 years. And along the way, you may find yourself in a spot where you've got to make financial commitments, whether it's doing financial due diligence, it's doing legal documentation. And if you don't have a partner that you've teamed up with, but you've made those commitments, it could wipe you out. So that's what I meant. Now, on the positive horizon, I think PE groups are going to have a need to find more deals sourced by independent sponsors. And I don't know if you guys are aware of this, but in August of 2025, Trump signed an executive order directing the Department of Labor to facilitate broader access to alternative assets inside defined contribution funds like 401ks. So that hasn't been a source of capital for PE to tap into in the past. And as recently as March of 26, the Department of Labor proposed a rule that's designed to give 401k fiduciaries more protection if they put investments that are part of retirement funds into private equity deals. So I do think we're going to, those things haven't been finalized, but the wind is blowing in a way that there's going to be more capital available than there's been. And that's just going to increase the demand, in my opinion, for independent sponsor deals. So it's not, when I say fallout, it's more, the more emerging independent sponsors that are in the ecosystem, the more are going to fall out because it's so difficult to do this on a sustainable basis. One other comment, many independent sponsors aren't doing this to build a sustainable model. They're doing this as a means to raise a fund of their own. So they're going to be out there looking to get deals done and then say, look at our track record and raise it. That's not a category of independent sponsor that I think is vulnerable.
Bruce, we were thrilled to get you here. There's a lot more to say. You did a piece, the 7 common pitfalls for emerging independent sponsors. I think we hit on a couple of those maybe, but we weren't even able to get a deep dive there. So more conversation to be had for maybe a later appearance. But we thank you for coming on the Minds Capital podcast for this first time.
Well, I appreciate it. And just kudos to the two of you. It's very meaningful to me when I participate in segments like this, that the moderators themselves really understand the model, and you guys do. And so that was very helpful in terms of digging into stuff where I felt that I could, be more enlightening than just try to explain what is an independent sponsor.
Great. Thank you for that, Bruce. Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraisers. See you in the next episode.